Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend Jeff Santoro, the voice of the people. Hey buddy.
Hey, how are you?
Finally starting to see some light of day, being a parent of a student who's also a big sports kid. Getting close to the end of the year, it's been tough. We have 3 sports events left on the calendar, and then I'm free for the summer.
So I have 100% more children than you, and they're older. And I've realized that there are no downtimes. There's just the time before the next uptime.
Yeah,
It's
no,
like,
that's right.
you're
That's
like,
right.
I just got to get through this 3rd sports event, and then you'll get through it. And then it's like, oh, now there's this next thing that will consume my life for 3 months.
Yeah, there's never the end. It's just the beginning of the next.
Yes.
That's exactly
But then
right.
your kids are gone, like I'm about to experience with one of mine in about a year. And I'm sure that'll be sad, and I'll wish for after school sports events.
Hey, Jeff.
Yeah.
The people didn't show up to hear us talk about our kids.
Children unscripted.
Here we go. All right. We actually do have a plan for a episode today about investing in stocks and stuff. And we're calling it Market Vibes 2025. Preliminarily, that's what we're calling it, which of course means that's what we're going to end up calling it because we won't come up with anything better.
I think the most unscripted part of our collaboration here is you naming the titles in the show before we've decided what the title's going to be.
Yeah, I do that. Get it on tape.
But that is, so you're right. We will likely stick with that title. We'll find out when this drops. But because of what we're going to talk about, I think we have to timestamp this conversation. So we're going to talk about all things market vibes because it has been a wild ride. And I think you and I collectively have talked about this into a microphone in other venues a lot since the beginning of April, but not necessarily here on our show. And so we're recording this June 5th at the end of the market day. So this will go out to all of our loyal listeners on the 11th. So God knows what will have happened between now and then, especially just a few minutes ago, I saw even more escalation of this Elon Musk, Donald Trump drama, which we're not going to talk about, but just to timestamp where we are in this, who knows what will happen between now and then. But here's what made me want to have this conversation. I'll just get a quick story about my own portfolio and why I thought this would be an apt time to do this. So every month I update a spreadsheet because, I like spreadsheets, Jason. Did you know that about me?
I've heard that about you.
Yeah. So every month I do a thing where
So do you have a spreadsheet ranking your spreadsheets by both order of importance on one tab and then another tab, ranking them by like your most to least favorite?
No, but I've thought about making a Google Doc that links to all my spreadsheets.
I mean, that's you should definitely do that. You don't have that already?
Speaking of things that people did not come here to hear us talk about. So every month I update my total net worth and the net worth of my investing portfolio, just so I can track it over time. And it's a fun little exercise because it makes you go like, oh, wow, this was a good month for the market, or this was a bad month for the market, whatever. And so I did it last weekend at the end of May, and my investing portfolio hit an all-time high, just total dollar amount, right? So some of that is my contributions and some of that is obviously market returns. And I would have been more shocked if I hadn't already known that May 2025 was the best May since 1990 and also the best month for the markets since 2023. And I say all that as a prelude to, if you had asked me on April 8th when we were what we now know was the bottom of this post-Liberation Day market crash that we had, if you had said, hey, in 6 weeks, your portfolio is going to hit an all-time high, I would not have believed you because everything was insane at the time. And it has not gotten less insane since, yet the market seems to be vibing just fine. And I am dumbfounded by that. And I don't think it will last. And I think we should talk about it.
No, I think it is a timely conversation, that's for sure, because everything you said is true. And one of the things I like to do when we're doing episodes like this, because we've done episodes like this before, where we've talked about where the market was, what was going on, how we feel about like our observations and like as an investor of, kind of how we're feeling like things are going to go. And the interesting thing about it is we're almost never right.
Well, speak for yourself.
Happen in
I'm
terms.
usually right.
So Jeff always thinks he's right.
Yes.
That's
as a former colleague once said to me, I'm often wrong, but never in doubt.
There you go.
That's kind of how I live my life.
That's exactly right. That's strong opinions, loosely held. But I think the thing that's interesting is back in December, we did an episode talking about the market rally. And of course, this was the rally post-presidential election was going on. And ironically, we did a market crash episode about a week after the president was elected. So obviously we were wrong about the market. Well, I shouldn't say we were wrong about the market crash.
We were right for a short amount of time.
What we were actually talking about was, were we headed towards a market crash in 2025? And of course, the market was very euphoric after President Trump was elected. You have a very pro-business administration talking about tax policy, 15% corporate income tax rate is still, that was a big part of his platform. It's still on the table at some point. Right now, they're trying to extend the income tax cuts that were done back during the first Trump administration, trying to pass even more tax cuts that would directly benefit mostly the ultra wealthy, largely people that own massive stakes of large companies. So all of those things are happening. Less regulation, all of these things that are typically being viewed as like, these should be good for business. They should be good for the economy, should put more money in people's pockets that they can spend, encourage investment as well, right? So all of those things drove the market definitely to some kind of euphoric highs. And then everything started to come crashing down. Really, it was in February, March when the tariffs on Canada and Mexico were put in place. The market started to falter. And then Liberation Day is somebody quipped, I wish I could remember who it was, somebody quipped that it liberated them of a substantial portion of their portfolio.
Yeah.
We saw the market fall almost 20%. The S&P 500 almost fell 20%. And then, of course, retail investors, as we talked about on last week's episode, showed up and screwed up a perfectly good market crash, right?
Way to go, everyone.
Yeah. Great job, everybody. Way to screw that up for those of us that wanted it to fall more. But no, seriously, the market's largely recovered, and here we are. It's still down from the all-time high, but it's largely recovered. And I mean, we need to talk about what's going on. What are our expectations? And then what we're doing.
Yeah, I think the what we're doing thing is what we'll try to keep coming back to. So I think it makes sense, Jason, to, now that we've kind of set the stage for why we're talking about this, where we are right now, let's talk through like the big topics that are driving the market here in 2025. So I think the first one that we have to start with is tariffs. We've already mentioned it a few times in our opening preamble here, and it's clearly the biggest news story, or at least has been up until, maybe we'll see how this bill working its way through Congress, if that kind of takes the headline here for a while. But since really the beginning of the administration, but certainly since April 2nd, that's been the hot topic in markets. And the thing that has moved the markets day to day, most definitely. What's wild to me right now is, even, I know that, you can point to the walkbacks of certain things and the pauses of certain things and say, well, that's why the market's responding positively. The news isn't as bad as it was. And certainly I agree, it's better to have announcements of pauses and deals than it is to have announcements of even higher tariffs. But the two things that I think I can't keep getting out of my mind, one is, who knows what happens next, right? There's nothing stopping all of these from going in the other direction at the whim of one person. But the second thing is, we haven't really, as consumers and as just regular people, felt the impact of what has already happened yet because of how slowly the supply chain operates. Just today there was Just today there was an article about how imports were down 20% in April, which was like a record decrease month to month, as the beginnings of that impact were starting to work its way through. But that doesn't mean we're going to see that necessarily in higher prices yet, or things more scarcely available on shelves in stores, or maybe not available at all. Who knows how this impacts the back to school and holiday season, where those orders would have been placed back in February, March, and April. And that's just if nothing changes for the worse from here on out. So that level of uncertainty, both aspects of it, the idea that it could change at any point, and the fact that we haven't really seen the impact of it yet, which means we haven't really seen the second and third order effects of it, of people maybe pulling back on spending. And then how does that impact the economy and businesses? And do they stop hiring? And do they start laying off? Like all that other stuff. We haven't even gotten to that yet. And the market just seems to be like shrug emoji YOLO to the moon. And I don't get it. It doesn't make any sense to me. Like, everyone says the market hates uncertainty, and it feels no less uncertain than it did 6 weeks ago, yet here we are.
To put some numbers to what's going on, I think that's always useful. Right now, the imported steel and aluminum tariffs are in effect, 50% on a whim.
Yeah, it was
President Trump
25% like 3 days ago.
just doubled them. And it's hard to see what the exact justification was for doing it. And I guess here's the thing, there is some real tension in industries like that with price increases where they help producers and where they really start to hurt. And that tension is between being able to raise prices and maintain volume. And when prices rise to a point where volume falls off precipitously, the fixed costs that companies that like steel producers deal with, which are very, very high, the economics no longer work when volumes start to fall. 25%, I think the industry was somewhat happy with, actually, because even if it affected their volumes a little bit, the expectation was that it was going to hinder imports, and that even if it affected U.S. demand, U.S. steel producers would still benefit because their volumes would hold up, even if overall demand went down, because they would be offsetting lost imports, right? And at 25% higher prices, right? So that was the theory at 25. And at 50%, we saw a number of steel stocks skyrocketed. Cleveland Cliffs especially was up like 25%, because it's the one that struggled the most, actually, most recently, because it acquired AK Steel a few years ago. The whole idea was its core business is iron production, and then it sells to steel makers that turn the steel into iron. Excuse me, the iron into steel. It bought AK Steel to vertically integrate. AK Steel was one of its biggest customers, and it could kind of leverage that relationship directly, lock in those supply contracts by owning that business. They're shuttering a bunch of facilities, and like there's some facilities that will probably be permanently closed as a result of just the challenging environment over the past couple of years. The stock shot up because I think the market expects, hey, this is the one that struggled the most. Tariffs are going to make those facilities they're shuttering now economically viable. That never works out in the long run, because the bottom line is that imported steel is not being subsidized so much that it's undercutting domestic steel anywhere near those levels, right? So that's an example of tariffs. And then I think writ large, the 15% tariffs are still basically in place. Think about that. That's not back to normal. That's not back to the way it was in 2024.
Yes.
So we're forgetting about that. And like you were talking about supply chains, companies order in the spring, retailers order in the spring for the holidays. So we're in a situation now where just the train cars are going to start crashing together for companies to be able to fill their shelves. I think it's just kind of where we are.
My best guess as to why the market has kind of been shrugging off the tariff stuff is this. Yes, right now the news is better than it was. I think the big thing is the current pause with China, right? That's a good thing for the markets to think. And I think maybe as this has flip-flop back and forth over the past couple months, maybe the market's thinking all of this is nothing until it is something. Maybe that's the tact it's taking. You know, this is all noise until something is unloaded at a 145% tariff. Like it's really not real till then. And maybe that's what's going on. But I guess the last thing I've been wondering is, you know, does corporate greed and pay to play lobbying keep us all from going down off a tariff cliff, right? Like, you know, say what you want about our economy and the way our government works, but like the people who have the ear of any administration are huge corporations, especially right now.
There's a reason why companies fund lobbyists.
Right. So I do wonder, I do wonder if that's where the optimism is coming from. Like push come to shove, some CEOs are going to get in the president's ear and say, you have to stop this. And we kind of saw it already, right? Like right before the pause, I believe, was when there was that meeting with the big box CEOs where they were like, we're like 2 weeks away from having nothing on the shelves, right? So that's like my hopeful yet sad for our democracy kind of way of looking at it, is like maybe the rich people are what keeps us out of something really bad. Yeah. But I can't point to, well, as it pertains to tariffs, I can't think of any other reason for the market rebounding than just they think it's all negotiating and nothing is actually going to end up happening other than this 15%, across the board thing, which isn't good, but at least it's a known thing.
That's going to end up at the Supreme Court. Let's be honest about that. This federal appeals court that has re-implemented those tariffs.
Oh, yeah, but I don't know that my understanding is that only applies to the reciprocal stuff and not the base level.
No. The only thing that it doesn't apply to is like the section 232 and 301, I believe, which are the ones that are around like that, basically like national security and defense. That's why presidents generally, when you see them putting in tariffs on things like steel, raw materials, because a lot of times those things kind of get pulled under.
And semiconductors and things like that.
Not as much as you think. So I mean, to a certain degree, yeah. So
But you
their
could make the
ability
argument,
to,
right? I think that it's
yeah,
just
yeah.
national.
Right. So their ability to restrict trade, not tariffs, but their ability to restrict trade, to be able to say you can't sell that to China. So that their ability to restrict trade, yes, but their ability to tax and levy, that belongs to
Right.
Congress, with very very defined examples around temporary emergencies and security and defense. So that's why we've seen administrations regularly put tariffs in place. Again, and my time following the steel industry closely goes back to the Obama administration. So, you're going back 15, 16 years ago at this point, where the Obama administration was using those against India, China, and I believe actually against the UK briefly, before the fact that there was some steel produced in the UK that we have to use to make certain warships kind of got overruled. And then through every administration that's happened, they've continued to follow suit because China continues to dump steel into the US and other markets. So anyway, all of that to say, my expectation for that is that it's going to end up at the Supreme Court, because the rulings so far have said, look, this is a constitutional authority that's granted to Congress. Congress, per the Constitution, cannot cede that authority
Right.
to the president, to the administration. So
And that'll get
it's
litigated.
going to go to the Supreme Court. So we're not going to have an answer before like this fall, if we're being honest. But back to your point, is I think there's this certain amount of optimism that it's all just going to go away. But there's another thing too, that's important. And you mentioned market multiples being essentially all-time highs. They're very, very close to it. But I think the bigger thing to remember, I was talking to Lou Whiteman. He and I were on a live stream earlier today, and he had a hot take. And it wasn't really that much of a hot take, but he's like, look, the stock market always bottoms before the economy, every time. And I can tell you, going back to the financial crisis, the market bottomed in March of 2009 before it started to recover. I can tell you in 2010, we were terrified that Europe was going to pull the world back into a recession. It was really 2011 before like most of the biggest worries were started to be kind of calmed. And it looked like the rest of the world was doing okay. And then in the financial or in the pandemic, there was exactly the same thing. Now, you could say for artificial reasons because of the stimulus that was pumped in, but it's typical. That's not atypical. So maybe that's the case here. The market's already said, okay, we're going to go down. We're coming back up. Thanks for screwing that up, retail investors. But here we are.
Well, and that leads me into the next thing I wanted to ask you about, because obviously what I'm thinking through this whole time from, let's just say, April 2nd to now is, okay, how do I think of this as an investor who buys stocks in my portfolio and things like that? So here's kind of all the thoughts I've had over the past couple months, but like squeezed into like a 30-second response. So first of all, my baseline is, with everything macro, is sort of like, no need to rush into anything. So I didn't do anything differently in April and May. I basically did my normal buy every couple of weeks, one thing, and that's it. I didn't really even think that carefully about what I was buying. I have to admit, I ended up buying more Warby Parker stock, which is a new addition to my portfolio, but not right away, because that was one of the ones when the big China tariffs were announced, they dropped like 17% because they buy all their stuff from China. And then of course, when they were paused, their stock jumped back up almost like the same amount, like 15, 20%. After all that craziness is when I bought it. But I have to admit, I wouldn't have bought it April 10th, right? Because like I have long-term conviction in the company, but at that time I was thinking to myself like, well, maybe just wait and see how this one plays out. And I think I even said it to you, like if they can no longer be the low-cost provider that they are, that's I don't want to say thesis busting change in the reason I bought the stock, but it's pretty significant. So I can't say I completely ignored the tariff impact in my own buying, but I certainly didn't sell anything because of it. So that was one thing I was thinking. The other thing is, and this, I know a news story is significant when normal people in my life ask me about it. And I was at a party sometime in April, and just random people who were there were just talking about tariffs in the economy. And I was like, well, that's weird. Like, that's not the kind of thing that normally comes up around people who aren't like us. And some people were saying things like, I'm going to sell my stock, or I'm not going to buy, or they were sort of gloom and doom. And it got me thinking, man, and then looking back, it got me thinking, if you had decided after the first couple weeks of April, like, man, this is crazy, I'm going to cash, you would have missed a big rally,
Yeah.
So now again, the
Right.
flip side of that is, of course, what am I doing right here on June 5th? I'm saying to myself, should have bought more stocks in April, but you can't look back and do that, right? I think I'm smart enough to know that that's hindsight speaking, but I'd be lying if I said I didn't have that thought.
So I wrote about it. You can go to investingunscripted.com and it'll bring you to the newsletter that we publish every week or so. You can also go to our Patreon, patreon.com/investingpod, and you can see the same thing. And one of the things that I did, I've talked a lot about my process and the framework that I built. And part of that framework, Jeff, is carrying cash. And recently, about a year or so ago, I started to increase the percentage in my portfolio of cash from 5% to closer to 10%. And I kept building and building and building, and it got pretty substantial. Now, a lot of that cash is held to cover short puts, but my goal is to have about 10% of my portfolio in cash that I could vest immediately, right? It's ready to put to work immediately. And that's why I keep it largely. We're getting more return on cash. So, as the market's gotten higher valuations, I've been mindful about that. And it's got bigger and bigger and bigger. That unlevered cash, at one point it was like close to 20%, but I almost only do it when we do have sell-offs to deploy it. And the thing that I wrote about is I really wanted to put my portfolio through this really close examination. It's like, I've got all this cash and the market fell 10%. It fell 15%. It fell almost 20%. What did I do? Did I actually do anything with that cash? And the reason I wanted to put myself through that and talk about it publicly is because if I'm not taking advantage of that opportunity, then I don't have a framework, right? I have a thing that's built based on my bias that I'm not actually putting to work to help me reach my financial goals in an effective way, right? And I went back and looked, and April 17th, April 15th, April 30th, April 23rd, April 28th, April 10th, April 17th, did I say the 28th?
Mm-hmm.
The 9th, I was a very active buyer. I was a very, very active buyer. And I deployed, call it half of the cash that I had available to invest during that period. So I did what I think I'm supposed to do. And just to put some names out there, First Solar, stock's been really beaten down. Added to ASML, bought a few more home builders, added to BBB Foods. It's the Mexican grocer that, tariffs don't affect the business at all. That was down a bunch. Added to Brookfield Renewable, Live Oak Bankshare, KNSL Capital, a lot of just super, really high quality businesses. Started building out a position in Walker and Dunlop, which, it's a business that's definitely struggled with interest rates, but I think it's going to do really well. So again, the point is I worked my plan, and I can tell you this, it was really hard to start pulling that trigger. But once I did, it's like, okay, I objectively see opportunity in these companies. Yes, the market's down 18%. It's still expensive. The president is still potentially wrecking the global economy. No matter what you think about the president's ideas and his goals long-term, it would be a multi-year, in an optimal situation, to do what President Trump wants to do and rebuild this manufacturing base in the United States to turn it into more of a global manufacturing powerhouse would take years to do. We don't have the people to do it. We don't have the people that are trained to even build these facilities, much less people that are trained to operate them and maintain the equipment and all that kind of stuff, right? So we're talking years and years and years to do it, and a hell of a lot of pain from today to that point. If you believe in President Trump's plan and that optimized idea to get there, I've heard a lot of people say, yeah, it's going to be some pain, but you know what? The pain's going to be worth it in the long run. Okay, if you believe that, you believe that. If you believe the opposite, which is this is all BS and a year from now, things are going to be back to where they are. Either way, the market was expensive in April, and it sure felt like there was going to be more pain before the recovery came. And then retail investors screwed it all up for us.
Yeah. And I read what you wrote about how you deployed your cash in the way that you did. And I really do go back and forth about this because there's part of me that wishes I was the kind of investor that had cash and that I did what you did. But I also know that in the moment, I would be saying to myself, okay, it's down this much percent. Is today the day to do this? Or if I send some of this tomorrow and then some the next day, but then we have 3 green days in a row that I missed my opportunity. I would get in my own head about it, which is why I kind of just did exactly what I always do. But then, and I think I knew there was a chance it would recover and that it wouldn't just keep going down and this wouldn't turn into a 30% drawdown. Like I wasn't really expecting that. I don't know that I expected it to recover so quickly and not have any more, like it's pretty much been back up since that like April 8th bottom. But here I am now on June 5th thinking to myself, like, I have had the money in my account to buy something since about the middle of May. Usually like twice a month I buy something. And when the second tranche of May money hit my account, I didn't do anything. And now the first tranche of June money has hit my account and I haven't done anything. And so now I'm thinking to myself, maybe I just wait. Maybe I do build some cash because, as I said at the top of the hour or at top of the recording here, I just can't believe the market's where it is. And I feel like the other shoe is going to drop at some point, but I don't know how patient I'll end up being. Like, I'll probably have a day where I have a little more downtime and I'll buy something because I have the time and to think about it. But that's kind of where I am in my head about this. So I don't know, maybe at one point I'll accidentally build up some cash and take be a little bit more opportunistic in my buying.
Well, you're going to change as an investor. I think that's an important thing to remember, is that I've definitely been kind of more aligned with you. And a lot of that was when I still had a 401k, I still had a full-time job where the vast majority of my money that went to work in the market was going into employer 401k plan. So it wasn't like now where 100% of my assets and a big chunk of my wife's assets are in an account where we can buy individual stock. And
that's kind of why I feel like, but no,
it makes it harder though. It makes it harder because it is harder to build up what you feel like is really like a material enough amount of cash.
Yes, no, that part is true. But what I was going to say was, but because this is where I start to question my own process, right? The reason I don't have like a cash deployment system like you do is because I feel like I'm trying to time the market a little bit. But the other side of that is 85% of my investments are DCA through both my wife and I's retirement accounts. Like, I'm already doing the buy every 2 weeks, regardless of what happens in the market thing.
Right.
It's the same reason I sometimes think to myself, I should only own like 9 stocks, because why own 40 stocks when those 40 stocks together are 15% of my invested wealth, right? I should be more concentrated, or I should take more risk with this stock portion of my investment money. And maybe I should be a little bit more opportunistic with buying and keeping cash and doing something like you do, because I have the DCA taken care of over here, right? So that's where I kind of go back and forth with this, and all the tariff stuff and the market moves. You know, we've had more up 5%, down 3% days in the past 6 weeks than I can remember.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
One thing I want to add, I think is interesting, talking about like that challenge, like that tension between raising cash versus deploying cash and trying to like figure that part of what works best for you and optimize it out. May, I was a very different investor. I've been a net seller of stocks. Not a lot. There's one stock that I held for forever, Curiosity Stream, and it got back to break even. And I decided, okay, I'm ready to move on. So I sold that and raised some cash.
Wait, hold on. I was listening but not paying attention. Curiosity Stream got back to break even?
Yes, the stock got over $7 a share.
How is that even possible?
Isn't that crazy? Yeah, yeah. They're making money for AI. They're licensing their video content to AI developers to use it to train LLMs. So,
All right. And
isn't
that makes
crazy?
sense. As
They
soon as you
pay a
said
dividend
AI,
now.
yeah,
They pay a dividend.
it's okay.
It's crazy, right?
Good
It's
for you,
mind-numbing.
buddy. I'm glad you got out of that.
I held on to it because I'm like, let me just see how this plays out. And it got to the point, it's like, you know what? I've read their annual report every year, and I read it last year. I'm like, or this last year, I'm like, huh, well, that's a thing. But it was the point to move on. But I've been a net seller of stocks. The only stock that I bought in May was assigned to me. It was a put that was assigned to me in Dava. Yes, I'm an idiot. Yes, for everybody that's listening, Jeff is glaring, shaking his head. It's that teacher look. It's like, you know better, kid.
I'm still mad at you for talking me out of selling when it was like almost
It
break
was a
even.
mistake.
Yeah.
It was a mistake. I'm buying shares at $15, by the way. I'm kidding. I'm not. Maybe I am. We'll talk about it later. But what I have been buying more of this month, because I've talked about the idea of rebalancing, is I have money from dividends and the sale of Curiosity Stream and that kind of thing. And I've exited some puts, some short puts. I've bought them back at a profit. So that's freed up that cash that was tied to the option. I'm buying bonds again, bringing up that percentage of my portfolio in bonds. So I've been investing in my bond funds.
Yeah. The other interesting thing about my portfolio, remember I tried to go through all of last year not selling a stock, and then I failed like in, I don't know, March, April.
Yeah. And when you failed, you just gave up.
By fail, I mean stopped doing the thing I said I was going to do.
Right.
I sold one stock on January 24th of this year, and I've not sold anything since. So maybe this is the year probably not. I'm going to sell something tomorrow. All right. What I was going to say before you wanted to go back and add on to that last piece there was, I think the next thing we have to talk about is inflation, because that's the next thing that I think we could see if the tariff stuff when/if
as those input costs start to affect products that consumers are buying.
Yeah. And it's interesting because, one of the things that moves the market is when we get these monthly inflation numbers, but they're a month behind, right? So you get them in April, they're for March. You get them in May, they're for April. So I don't know, like we may get the ones for May and June, and they may still show lower inflation or steady inflation. And it may not be till July or August or September we start to see inflation tick up if we do. But that, I think, could really be something that puts the brakes on this little market rally, because I think then it's going to kick up all the conversation about the tariffs again, wherever we are with that. It's going to kick up the conversation about what's the Fed going to do with interest rates. I mean, we're already to the point where I believe the consensus is just one rate cut in 2025. And I don't believe people are expecting it before September or maybe even December. But if we start seeing inflation creep back up before then, who knows what it does to that. And if that inflation comes along with slowing growth or higher unemployment, then we're in a real tricky situation, right? We're in that stagflation twilight zone where raising rates and lowering rates is both the right and wrong thing to do at the same time. So I think that's the reason I'm comfortable waiting and not rushing into buying stuff right now, because I think the market's going to cool off again, if not crash again. I just feel like inflation's got to come back. Like you said earlier, like even if nothing new happens and we just have these 15% across the boards, and we have the steel tariffs and the Mexico and Canada stuff that was like from before. And what's China at now? 30%, right? Didn't that get lowered to 30 while we're on this pause or something? Like that's going to impact us. It has to.
Yeah. Yeah. Honestly, I don't know what the latest rate is on China, but what I do know is that the Department of Labor, like almost every other department in the federal administration, has seen severe staffing cuts. Now there's real question about what is the quality of the data for things like CPI going to be. I don't think there's intentional thumb on the scale happening, but I do think that, they just announced like there's Utah and Nebraska, they don't have enough staff to effectively analyze the data. That data may not get rolled in from cities in those states. So there's going to be questions about how accurate the data that we're getting is going to be. But I do know that the latest University of Michigan consumer sentiment survey, we're 2 months in a row, like some of the lowest levels, like almost ever for that. So there's no doubt that it's already affecting consumer spending behavior, because when consumer sentiment is low, It's low because they've already started to take action to pull back. And I think the expectation is that costs are going to be like 6% higher next year. So that's where sentiment is,
Yeah.
right? And sentiment drives a lot of these things. So,
And speaking of the CPI data, there was a really interesting episode of Odd Lots within the last couple months where they talked to someone who used to compile that data. I think it was someone who's formally in that, not currently in that job, but I didn't realize this. There's actually people who, like tons of people who they go and they buy appliances and they buy like boxes of cereal and bags of chips, and they count the chips and weigh the cereal to see like where is the shrinkflation happening, and then they calculate. That's how they help like calculate inflation. It was really fascinating. I had no idea it was like that detailed. And then there's a lot of survey data too. But so just if anyone's interested, go check that out. I forget which episode it was, but if you go check the Odd Lots episode list, you'll probably find it. But
yeah, it's funny how sometimes they interview people that are really wonks about certain things that turn out to be really great, interesting shows.
yeah,
So
there's two things, right? There's are there the resources there to get the data correct? And then I'll just say it. Would it shock me if there was some thumb on the scale with some of these numbers? No, not at all. I hope it doesn't come to that. I hope there's enough career employees at these organizations to make sure that the data comes out legit. But regardless, the one thing you can't fake is the price people pay and the anger they feel over it. Like that's what killed the approval rating for President Biden, right? He faced high inflation because of all of the spending coming out of the pandemic. So this is again where I've thought about building a bigger cash position, because in a world where the tariff impact actually starts to hit and or inflation kicks up and now people are paying more for eggs again, to use the example that everyone keeps bringing up, does that slow the market down? It sure feels like it would or should.
that's one of the things that I keep thinking about too, is that, and I hinted at it before, but that talk about that $40 billion that retail investors, the new money that they brought to the market back in April, it's the most ever. It came during a period when the market was down, but the economy was fine. There's data coming out that it is taking people longer to get jobs, and things aren't great, but they're not bad. Things are pretty good overall, and consumers seem to, and this is speaking broadly, of course, I don't want it to sound tone deaf because there's plenty of people that are struggling. I get that, but writ large, consumers are not struggling yet. But that's the point, is the thing that, like we talked about in the episode last week, what happens when that dry powder is the emergency fund now, and the emergency fund has now gone into the stock market and somebody out of nowhere loses their job. Then you can't just hodl, right? Then you're not buying the dip, you're paying the bills.
Right.
And the calculus completely changes. And I'm not predicting that that's going to happen, but we don't know how that's going to play out. But I mean, I think that's what comes back to just like the toolbox, right? And we have to invest through the worries and the euphoria based on our short-term and long-term goals, and not letting all of the incentives and our biases and emotions take hold of the wheel, because that's when we go off course.
Yeah. I mean, one thing that I've been thinking about too is I have a lot more non-investing cash than I usually do because of money that I'm saving to pay for college. And well, I should say money I'm keeping out of the market in order to pay for college is a better way to put it. And when I remember thinking in April, when everything was crazy and we were almost into a bear market, thinking to myself, this is not why I have all this cash on the sidelines. It's more that I just have a high school student who's about to go to college, but it kind of feels good that I do, like the timing was just fortuitous. And it does have me thinking down the road. And this is for me, 9 years down the road, when I'm through paying for college for both of my kids, do I want to keep just a higher level of cash out of investments entirely? Like, do I want my safety net, my emergency fund, to be bigger than it should be, quote unquote, based on like what people say, this many months worth of expenses,
right?
Just as a sleep better at night kind of thing, like that. I don't know. I'll make that decision in a decade, but it is something on my mind. So here's the last thing I think it's worth spending a few minutes talking about, which is the other big news story that has been bubbling up and I think will become a bigger part of the news in the coming weeks here. It's sort of three things at once. It's the tax bill that's working its way through Congress. It's the credit downgrade, which is partially from things like increasing the debt from things like this tax bill that's working its way through Congress. And it's the impact that that's having on bond yields. And what's interesting to me is the thing that reporting has told us caused President Trump to pause the tariffs was when the bond yields got up over 5%.
Yeah,
Apparently,
the treasury auction almost came off, the wheels almost came off.
right. But my understanding is the yield on the bonds, or at least maybe, I don't know today, but like when that credit downgrade thing happened, were close to that same level, and there didn't seem to be as much alarm.
Yeah.
But I do wonder, like, what does all this do to markets in the economy if and when this bill passes, and if people start to have a little less faith in the government's ability to pay back its debt because it's about to add another 3 or 4 trillion to it. I don't follow the bond markets that closely. Like, everything I just said is stuff I've learned in the past couple months, but it does seem like more than a market crash, a bond crisis is what really shakes the market writ large. So
that's what funds a substantial part of the U.S. government.
right. So basically people don't buy our debt, right? So
Yeah.
we have to at least say out loud that, like, this is a thing that could impact investors. And I don't know what to do about it, because it's certainly a possibility, but not an inevitability. But I think for me, it's just another reason that A, I can't believe the market's where it is, and B, I just have a feeling things are going to get worse at some point.
Yeah, the credit market thing is really interesting to me because the government's funded by selling debt. Our taxes are the bulk of it, but, well, there's a deficit. We have to raise debt every few months to come up with that excess cash.
And the wild thing is that defense spending is number one, and interest on our debt is number two in terms of what this government spends.
Interest on the debt is about to pass.
Yeah, but it's second right now, but it's
government
approaching.
spending. Yeah, it's about to become larger. So that's problematic. I think that is problematic. And the thing that I wanted to say, though, as far as like the debt rate, the downgrade, Matt Levine wrote about it in Money Stuff, and he pointed out, it's like, look, it's signaling it's not a real thing.
Yeah. It's just, I don't think it, but it's tied to those other two events. That's all I was saying about it.
No, it is, right? Exactly. But again, the bigger thing is that I think we are hearing more voices from more perspectives that are talking about the deficit and the government debt in ways that we've never heard before. So at some point, something is going to have to happen. Higher taxes, cutting spending in where the real money is. Or you could fire half the government employees, excluding the military, but you could fire half the people that work for the administration and all the agencies, and you lower government spending by like 2%.
Well, that's why the whole Doge thing was so stupid.
It's signaling, man. It's signaling. Yeah. We know that. Most people don't know. They think half the government it pays people, and that's not true. I mean, it does. It flows back into the economy largely, but the key there is that until somebody puts together a real plan to lower defense spending and to lower Social Security, Medicaid, those, like, to either cut those programs or raise taxes, likely, then everybody's just signaling until that happens, right? It doesn't matter what political position they're coming from. It's all signaling until somebody actually puts together a plan to go after those things. But I think the main thing for us as investors is we have to invest in the environment and the market that we're in with the tools that are at our disposal. So that's one of the things that I've really tried to focus back on when we go through periods like this, where my natural biases kick in and it feels like it's harder to find something to buy, or I'm worried about a sell-off. It's thinking about those long-term goals, the short-term goals as well, and making sure those are well prepared for, but then using the best tools I can to get the best return within whatever my risk profile is based on the environment on the ground. So, for example, you and I are going to do a rough cut exclusive for our Patreon members about CrowdStrike. I've gotten to the point now where I'm thinking about selling CrowdStrike and then selling puts at a much lower price, because I don't see a lot of forward momentum for the stock, and I have some real worries about the business at these valuations. But that's, we'll do that when we do it. But the point is using tools like options and thinking about our biggest, most powerful tool that we have. Don't be dirty-minded, Jeff. It's time. Yeah. It's time. And that's the thing that lifts our portfolios the most, is time.
Yeah. And as much as I keep saying, like, I can't believe the market's where it is, I think there's more trouble to come. Like, I actually do believe all that, but I don't think I would invest like that, because I could be wrong. And as I said at the top,
yeah,
if you had asked me in the middle of April, where my portfolio would be at the end of May or the beginning of June, I would not have believed where it is now. So if I had decided back then, I'm going to change my whole process and I'm going to do this, I'm not going to buy whatever, I might have missed something. And so I think that's why, even though I say like, I think there's going to be this happening later this year, I could be wrong entirely. I could be wrong by a year. I could be wrong by 5 years. And if I don't do my normal thing and the market goes up, then I'm missing out on that growth, right? So I think that's why I end up, even as I said earlier, maybe I should be a little bit more discerning with cash in my stock portfolio because of my dollar cost averaging in other places. I think I'm probably just going to end up largely doing what I've always done, not try to time the market, invest in the market we currently have, like you said. Maybe I'm a little more discerning in like what I buy when, right? Like I used the example of Warby Parker earlier. Maybe I do try to put my money in places where at least there's a little less impact from tariffs, or maybe there's a sector of my portfolio, part of my portfolio that's a little less impacted by the current events. Like I don't think toying around the edges like that is necessarily the worst thing in the world. But yeah, I just keep coming back to I'm often wrong, but never in doubt, as I said earlier. But I need to invest as if I'm just the first part is true, that I'm often wrong, and not do anything to blow myself up.
Yeah, no, I think that's right. Jeff, before we wrap it up, I just do want to just reach in. We've got with our starter position plan in Patreon, $5 a month, with the Discord that we've had a lot of really fun conversations in the Discord. And I just want to invite more people to come join us. So go to our Patreon, patreon.com/investing unscripted. Give us $5 a month. You're going to get some cool stuff there. But Lewis Brooks has really started to help kind of drive the conversation more around options. Wayne Cunningham has finally joined us. Wayne, he who was the catalyst for this,
Yes,
this whole thing to get going, he's joined us as well. So, and I want to hat tip to Jen Roberts, she's the tech genius that's putting this whole thing together, making it work for us. So I just wanted to say thanks to Jen.
Yeah. And while we're quickly going through our housekeeping here, in addition to the Patreon, don't forget we have the email newsletter you can sign up for. You can find us on all the social media accounts. We're in a little bit of a dry spell as it pertains to ratings and reviews on the podcast apps. We talk about a lot of stuff that we're doing, but the main thing we're doing is trying to put out quality content for free every week in podcast and on video. So if you could be so kind as to give us a 5-star review and write a 5-star rating and give us a nice review on Apple Podcasts, that would really help people find the show. And lastly, if you're interested in more stock talk, straight up stock talk, there's always our Savvy Trader portfolio, which you can subscribe to at savvytrader.com and follow our stock picks in that portfolio and watch our videos where we talk through our thinking. And it's really where we put the toolbox of all the things we're talking about to work and making monthly stock picks in whatever market we find ourselves in. So with all this talk about what to do, we're going to show what we're actually doing. So those are some other places you guys can get more content from us.
All right, Jeff, I think we're done, right?
We did it.
Okay. All right, everybody, we did it. Now it's your turn. We've given our answers to this muddy, weird market that we're in, that the vibes, it's hard to tell exactly where things are going to go. That's where we think we are. We talked about what we're doing. Now it's your turn to figure out what you're going to do and find your own answers out there. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.